Hey guys, welcome to your fourth episode of Real Time Economics. Today we are going to talk about the Fed rate hike this week and how consumers in the rest of the world are being affected, and of course, most importantly, who will win this continuously intensifying trade war between the two biggest superpowers in the world today. That is, of course, China and the United States. First, as expected, the US Fed did end up raising rates for the eighth time since late 2015 by a quarter basis points. The market expected, and gains in the US dollar were internalized before the start of the meeting. Analysts are expecting three more rate hikes following this one, and this may prove to be damaging for emerging markets and US debt owners in dollars. Net speculative long positions on the greenback increased by their biggest daily rise in more than 2 months. This is proving to be a major problem for most emerging market economies, as a strengthening dollar means that investments will be flowing out of the economy due to the weakening currency into the greenback, further weakening their currency. Secondly, most of these emerging markets face dollar-denominated debts. A rising dollar coupled with higher interest rates means that they will have to continuously pay more. Thirdly, countries that heavily rely on imports will face an imported inflation that will result in them having to find other ways to reduce costs, leading to higher unemployment levels. Hence, overall, rising interest rates have little good to do for the economies in the rest of the world. Now let's talk about who will win this trade war should it persist and if no deal is made. One thing's for sure, the Chinese have major upper hand in this, and should they not win, they should at least end up in a draw. We know that President Donald Trump believes that he has an upper hand in this conflict because the US economy is strong, and also because politicians of both parties support the strategic objective of thwarting Chinese rise and preserving US global dominance. However, this apparent strength will prove to be a downfall for the American economy because by applying the martial arts principle of turning an opponent's strength against him, China should easily win the tariff contest. Economists since David Ricardo have always argued that restricting imports reduces consumer welfare and impedes productivity growth. Secondly, comparative advantage certainly influences long-term economic welfare, but demand conditions will determine whether China or America feels more pressure to sue for trade peace in the next few months. And a focus on demand management clearly reveals that the US will suffer from Mr. Trump's trade tariffs while China can avoid adverse effects. From a Keynesian perspective, the outcome of a trade war depends mainly on whether combatants are experiencing recession or excess demand. In a recession, tariffs can boost economic activity and employment, albeit at the cost of long-term efficiency. But when the economy is operating at near full employment, tariffs will merely raise prices and add to the upward pressure on US interest rate, which clearly applies to the US economy today. Secondly, US businesses cannot find extra low-wage workers to replace Chinese imports, and even the few US businesses motivated to undercut Chinese imports would need to raise wages and build new factories, adding to the upward pressure on inflation and interest rates. With little spare capacity available, the new investment and hiring required to replace Chinese goods would be at the cost of other business decisions that were more profitable before the tariff war with China. So unless US businesses are sure that the tariffs will continue for many more years, they will neither invest nor hire workers to compete with China. And assuming the well-informed Chinese businessmen know this, they will not cut their export prices to absorb the cost of tariffs. Instead, they will leave US importers to pay for that, and then it will be passed on to consumers. But let's say that the tariffs may price Chinese goods out of the market, either through making US industries more economically viable or by finding a suitable substitute through importing either from India or Vietnam or relocating industries in technology to South Korea or Japan, then this may be hurtful for the Chinese economy. But then again, I argue that this will only be to a limited extent. Additionally, this should have almost no effect on Chinese growth, employment, and corporate profits if demand management is used to offset the loss in exports. China can add steps to boost domestic demand, and this can be done easily through full scale Keynesian stimulus. For example, fiscal policy, monetary policy, or government intervention in other ways. Hence, it would be in the best interest of the US to make a deal with the Chinese to avoid possible detrimental effects against their economy. Donald Trump's surprisingly rhetoric technique of shout loud and carry a white flag helps to explain the consistent inconsistency of his foreign policy. The US China trade war is likely to provide the next example. And that's it for today, and I'll see you next week for another dose of real time economics. Please do not forget to like, comment, and subscribe. Thank you so much.